Hey everyone, I know I'm supposed to wait till 3 o'clock, but I couldn't. I couldn't wait. I'm a couple minutes early, but that's okay. I've got the ETF show, my ETF show, 3 times a week, Monday, Wednesday, Friday, and I was just so excited that I couldn't wait until 3 o'clock. We got a lot happening in ETF land, everyone. A lot happening. My guest today, it is a really good day. I didn't plan this. Well, I mean, I did, but I didn't know it was going to be like this when I booked him. But Bruce Liu, the CEO and portfolio manager at Esoterica, he runs an actively managed tech ETF. And what's in the crosshairs? Tech ETFs. So that's what we're going to talk about today. The ticker for his fund is WUGI. But a lot to get to on today's show. I've got a half hour. I'm going to try to cram it all in. Is it 3 o'clock yet? It is. I'm going to play my intro. Let's run this thing back. All right. Welcome to the ETF show, everyone. Spencer Israel here from Benzinga. Let's get my name up on the screen so y'all can see who I am. There we go. All right, guys. Again, just a quick recap. What is the purpose of this show? Why do we love ETFs? Number one, I'm going to do this every time, by the way, so you're going to get sick of it. Number one, ETFs are diversified. Number two, they are tax efficient. Number three, they have low fees. Number four, they are usually actively traded. And number five, they are, again, usually transparent. So those are 5 reasons we love ETFs. I mentioned just a moment ago our guest today, Bruce Liu from Esoterica. He'll be on in, I don't know, about 5 or so minutes, and we'll talk about WUGI, talk about the tech trade, and get into all those fun details. But in the meantime, let's go into some trends, some top stories in ETF land, and we have to start, guys, with ARK and the craziness that has been the last couple of weeks. I will just pull up a chart here. This is the, let me pull that banner up. This is the 5 actively managed ARK funds going back to January. I think this is let's zoom out a little more. And you can see year to date, it ain't looking pretty, guys. It ain't looking pretty. And you know that I own one of these. I own the ARK W, and it's looking a little ugly, but that's okay. That's okay, because we're going to talk to Bruce about the long-term trends here. Again, I just want to show you the performance, and you can see that they're all down for the year. But let's compare this performance with flows, right? Let's see how the flows in here. Look at that, guys. Look at that. Look at those 1 week flows. A lot of people come in to buy the dip in ARKK last week. Look at that. Not so much in ARKG, ARKW, KQ, or KF, but in KK, $314 million of flows in the last week. The buy the dippers are coming in strong. Very interesting. Very interesting. Let me just show you my fund portfolio. You can see what I own and how I'm doing. I'm getting smacked around here pretty good, guys. Right? You don't know why you own what you own. I don't even have. Oh yeah, I do. Okay, I have my core holdings, again, VOOVEU. The rest of these guys make up like 5% each, right, of my portfolio, 10% each. But you can see there's a lot of red today. Really, for the past couple of weeks, it's been a lot of red. But that's kind of the way it goes sometimes, right? So there you can see what I own. People ask me what I own. There it is, right there. And what else? Okay, so we got to the ARK weakness. We got to the ARK flows. Let's go overall, though. Let's go overall market, overall flows. See what was in vogue, what was not in vogue last week. Look at this. This is so interesting here. Okay. The funds with the top flows last week. Look, you don't see. I mean, you see the VU right there, right? But look at this. It's non-US equity, right? It's emerging markets. It's the TLT, another emerging markets, total stock index, right? Value, right? Corporate bonds, right? Non-US equity funds were the favorite last week. And something else I want to draw your attention to. So look at the VU there, right? That's the Vanguard S&P 500 fund. And look at the IVV. That's the iShares S&P 500 fund. Those both had massive inflows last week. Go the other side, though. See, oh, who's that? The SPY led the way in outflows. These three funds do the same thing. So why did SPY have all these outflows when the iShares and Vanguard equivalents had all these inflows? It really comes down to one reason, and that is why people own these funds. SPY is generally considered or is generally used as an active trading instrument. It can be an investment. You can buy and hold SPY for the rest of your life and fine, you can do that. But a lot of people, a lot of traders use SPY either to trade by itself or as a hedging tool, right? They'll hedge their trade with the SPY. It is used as a trading instrument. And you can see those massive amount of outflows. A lot of active people, active traders, active managers are using SPY. A lot of passive people who don't really trade very often, they're the ones that are in VOO and maybe IVV. SPY is the S&P 500 fund for the active trader. So you see these outflows last week. It tells you where the people who have the quickest trigger fingers, where they are, right, and what they're doing. So I thought that was a very interesting digression last week between SPY and VOO and IVV. One last thing I want to point out before I bring on my guest here. There was a report out from State Street. And this is good because they have a nice, they're the third largest fund issuer by assets, I believe. So they have a nice overall point of view on the ETF market. And so overall, for the first 2 months of the year, according to State Street, US ETFs are off to their best start ever in terms of flows, okay? So US ETFs had about $152 billion of inflows in the first 2 months of the year. Jim Stocks saying you do not get redirected to the show. That's because I think my other show didn't end yet. I apologize for that. I think they went long. Oh, he says the link was wrong. I'm sorry, guys. That's my mistake on the redirect. I apologize for that. As I was just saying, though, State Street had a report out with overall fund flows through the first 2 months of the year. U.S. listed ETFs are off to their best start ever. Equity ETFs have brought in around $84 billion of inflows through the first 2 months of the year. Look at this too. Active funds as a group brought in $14 billion of inflows last month and are now up to $200 billion in assets for the first time ever. And that's going to be my segue here to my guest because he runs an active ETF. Bruce Liu is the CEO of Esoterica. He's also their portfolio manager. The ticker of his fund that just crossed the $50 billion AUM, 50 million, excuse me. What did I say, billion? $50 million threshold of AUM last week is WUGI. And I'll bring up the chart so y'all can see what WUGI has been up to. There we go. Let's zoom out. There we go. Let's bring Bruce on now. Bruce, good afternoon. How are we doing today?
Hi, Spencer. How are you? Thank you for having us.
Doing okay. How about yourself?
Very good. We're very excited to join you.
It is an exciting time. I'm glad I have you on today or this week of all weeks. Let's just start overall. You have benefited from what was an extremely good environment for funds like yours for the last year, right?
Totally.
And the tide has sort of turned in the last couple of weeks. So tell us about that and sort of how you're approaching the market now.
Yeah, I'm glad you brought that up. I also saw you showing the ARK ARKK fund. If you don't mind, if we can go back to that chart.
Yeah.
Actually, I want to walk you through the thought process. What I have been saying. Last 2 weeks has been tough. That's for sure. Actually, 3 weeks now. You see this WGI, that's fine too. You want
me to go to the ARK? The ARK, okay.
ARK, that's fine. People more familiar with the ARK. Let's do ARK. Okay. That's fine. Okay. You can say, this is a very exciting time. We are at the inflection point. The market dynamic does change now. And so you have to pay attention. Everybody was talking about this, rising 10-year treasury yield was like creating the troubles. But there are a lot of like nuances behind it. Just say year to date, and up to like the mid of February 12th, 15th, that was still a very healthy dynamic. You do see the 10-year treasury yield was rising up very quickly, but beneath it, that was more driven by the inflation expectations. The real yield, the difference between nominal yield and inflation expectation, was actually staying very, very stable and low. It's around like a negative 100%. That was the perfect setup for like risky assets. That's why you saw and all the equities reached the record high. That was the dynamic before that. But right after like the middle of February, that dynamic changed a little bit. Yeah. The 10-year treasury nominal yield keeps rising up quickly. Yeah. But that was more driven not by the inflation expectation anymore. It's by the real yield. In our eyes, that's the just tightening financial conditions. Many factors to that. You can blame like mortgage portfolio for that negative convexity hedging. You can blame Japanese banks for not like coming into the market to buy. So, but at the end of the day, that all amounts to the tightening the financial condition. So when you have this real yield rising up and quickly from like negative 100 bips to almost like negative 60 bips, that put a lot of pressures on the part of the markets. Which part? And that's where
we all know which part now.
Why? That's for the exact market is very efficient. It's killing that part for the precise reasons, And when you have the fast rising real yield, that put a lot of like pressure on valuations because that provides less, just multiple support. We benefit from there last year. Now, like that's turning. So that's the first part. Also, like high flyers, hyper growth names, and those names we call it like a long duration assets because most value of that stock. That's just the nature of their business. Where they are in the life cycle, they invest in heavily. They really try to generate values for the company for long run. So most value is determined by their term value, and we call them like long duration assets. When you have real yield rising up so fast, and that put more pressure on those long duration assets. So that's why exactly you see, if in your fund you hold like expensive hyper growth names, you got slaughtered. Although you don't see much on the SPY. I think that's what's happening now. And so hopefully that makes sense.
I'm curious what the last year or so has been like for you. So you've watched one of your peers, Kathy Wood, become a bona fide superstar, and you do the same thing she does, right? You're picking stocks as part of an actively managed technology growth fund. So and for the last decade, it's been a shift away from active into passive. Just close your eyes and index and never sell and call it a career. Just buy the SPY and call it a career. And now here we have again a stock picker is like the leading celebrity on Wall Street. What has it been like for you? You're an active manager. What has it been like for you?
Well, I think it doesn't mean like active management is right for everything. It really depends on what kind of like instrument that you use. We do thematic investing. Well, in my opinion, thematic investing is the perfect place you combine ETF structure with active research and active management. Well, if you launch a SPY, S&P ETF, it's not necessarily a good idea. And when you do, especially like we do with digital economy, in the 5G cycle, this is the process of like, you disrupting the legacy technology stack and building the new ones. So it takes a lot of like getting to know the new stuff, and there will be winners and losers. It takes active research to know who could win, which part of the pie is growing bigger and faster, who could potentially be the winners, benefit from this mega trend, and who will be the losers. So that's where you see the most benefit of like active research and management. Similarly for ARK, they do innovations. Those are the things it's harder to do like a passive index to really capture the most benefit. So I think, back to my original point, when you do a thematic investing, you really want to capture the benefit of, the future themes, the mega themes. I think, combining ETF structure with active research and management making a lot of sense.
So since most people are familiar with ARK by now, they know that ARK posts their trades daily for everyone to see. Explain your management process. How do you manage WUGI?
Well, it's now too much different from running any hedge fund, active mutual fund. We follow a very rigorous portfolio investment process and portfolio management process. And the way we look at market, we invest in the 5G enabled digital economy, and we look for the opportunity sets, and which are the in the semi space, in the software space, and the enabling application spaces. And we try to identify the winners and the losers within each basket. So decision making is it's a daily basis. We look at the names, and we look at the potential change of the thesis, and we adjust the portfolios accordingly. But we do not, like a hedge fund trade around the quarters. Although, really, if you look at our portfolio turnover last year, it is extremely low. I want to set up WGI as a true long-term investment vehicle. You really invest in the whole cycle. So think about this, like Spencer. We all know the mobile internet is the signature of a 4G cycle, right? In the 4G cycle, we're creating, we're connecting people together. So you see that after the whole cycle, who are the real winners and who are the losers? And if you go back 10 years, back 10 years, and you see this is your approach, and you bet on those winners. For example, Amazon, Google, Netflix, Facebooks, and some semiconductor names, and also cloud names. And you have faith in them, and you invest in them early enough, you benefit hugely. Well, I will believe that similar things are going to happen again for the 5G cycle, but the 5G cycle is much broader based. So we take that long-term view rather than playing the quarterly, if that makes sense to you.
Wait, tell us more about the turnover in the fund, because we know Kathy is extremely active, and you're saying you're not. So tell us more about that.
No, in terms of trading, and I believe our turnover is actually below 30% last year.
Yeah. So explain what that means.
Well, we do not actively trade. We try to find the names we like, have the secular growth potential. We stick to them. So that's what this amounts to. We change names or reduce exposure only when the thesis we think thesis have changed. And for example, we used to have Intel in our portfolio, but before the second quarter earning last year, we saw something wrong is happening, and we removed the position from the portfolio. Then the same week when the earning comes, it proved that we're right, and the stock reacted very badly. So those are the things we really adjust the portfolios instead of really trading in and trading out on a daily basis.
Got it. And it's so interesting. Your fund, and is down 20%. Your stocks in it are down more, but it's not as if 5G is going away, right?
No,
I mean, I think everyone is in agreement that 5G is not going away, and it's just so interesting to see. I mean, granted, if you zoom out, last year was incredible. Mm-hmm. So pullbacks are only natural, but it's just funny to think that if you're a long-term believer, I would imagine that the past few weeks, if nothing, represent a buying opportunity.
I totally agree with you. Like what I mentioned earlier, market is in the process of this repricing because of the fast rising real yield.
Yep.
Market is in the shoot first, answer the question later mode. It's killing every expensive hyper growth names. But it's not some names, they look expensive. If you look at the conventional valuation metrics, but they have tons of earning powers. They look expensive for the right reason because they are in the early stage of their life cycle. They invest heavily back into their growth. So that's where actually the active research contribute to this. If you do your research, you know those names. For example, we like C Limited. That's a Singapore e-commerce company. It looks expensive on paper, very expensive, but we just love the name so much, and it rides on the 3 secular growth trends, and the execution, the quality of the management team, everything is just fantastic. If you heard their recent earnings calls, they're doing everything right in our opinions. But now this is the time, the short-term market reaction. Shoot first, answer questions later. I believe one way. Some stocks, it's price for the dreams, and we do not like those names. We tend to get rid of those. We don't even consider those stocks in our portfolio. And we believe when market settles down, when back to the normal, and real yield may not go back to negative 100 bips anytime soon, or maybe never. And we have.
Well, hold on a second, a little bit, because I look at some of your holdings, and some of these valuations are a little out there, right? I mean, Square. You can look at Square.
Yeah.
You can look at PayPal.
Mm-hmm.
It's come off the highs now, but that's not my point. My point is that a lot of these valuations are stretched.
Yeah.
Workday. I mean.
Yeah, Workday actually within the space actually relatively Workday to us valuation is 2 things. Valuation is all relative.
Okay.
You have to put it into the context. When your real yield is at close to historically low, that means your risk-free assets are giving you nothing. So that actually the supporting the higher valuation. So that's how we look at the valuation metrics. A lot of people comparing. Let's take a QQQ for example, and this QQQ's valuation is so expensive, close to back to the tech bubble, .com bubble. But consider look at a relative basis. The real yield now is still in the negative territory. But back then, the real yield, U.S. 10-year Treasury real yield, is 400 bips. So you do nothing, your money is safe, and you earned 4% a year.
4%, right. Now you do nothing and you earn nothing.
Yeah, and you are losing money basically. You get a negative thing. So that's what's really driving the valuation. So to us, that's first dimension. When you look at the valuations, you have to put that into the context. It's all relative. Second, within that space, again, some companies, they try to tell you a great story and they get nothing. It's like telling a dream. People are chasing those names. It's all because of the liquidities. But some other companies, they actually have the true earnings power. So that's where, again, the active research comes into play. If you do your research, know those names well, I think you can really tell which companies you should bet on.
Okay, but Bruce, so what would you say to people who have loaded up on, it could be ARK or it could be any other technology growth stock. It doesn't have to be an ETF, any stock. They've loaded up and maybe now they're underwater. Maybe now they're getting crushed.
Yeah.
And what would you say? And again, growth technology, what would you say to those people?
Okay, 2 things. First of all, I understand this is not comfortable, especially after a fantastic year. People are not used to this. But this is the process of repricing. You have to wait until the rates, especially real yield, find to stabilize. I think David Tepper came out today is saying the same thing. And we are still at the early stage of the cycle. You got both monetary support and as a fiscal stimulus. You get 2 huge tailwinds to help you. So if you know where you are in terms of cycle, we are far away from the hiking cycle. We are still in the easing cycle, and we do everything to help the economy to grow. And this is the place you should take risks. Don't quit taking risks. But we have to admit it. The negative 100 bips real yield is really a good time. Now we're moving on. We are moving on. We might have to end up with negative 50 bips, maybe 0 bips. We don't know. We have to wait until the bond market's telling us. That does put pressure on the valuations, and that does put pressure on the hyper growth stocks. And so we're here. You have to be very selective. I tend to believe, for high quality, even it looks expensive, but for high quality and hyper growth names with the real growing power, earning power, you should feel comfortable and think the market will realize, and they do have value. They generate values for the shareholders. Stock is gonna coming back. But for those high flyers, had a good time only because of the liquidities, you might want to be more cautious. So that's my advice for people.
Question here from the chat, SG. He notes that you don't have any Palantir in your fund. I don't know if Palantir is a 5G play. I don't know if that's what they're considered.
We actually look at the names, and but one thing, to us, it's a consulting business model. It put a cap on their margins. We just have trouble believing their margin expansion, story. Also, when you are in a consulting business, and the earnings visibility is low. So those are the two primary reasons we don't have position in Palantir.
Got it. And you know what I'm going to do? I'm going to just run through the list of your top holdings here, because so you mentioned C is SE. You've got a couple of Chinese listed or Hong Kong listed stocks. Taiwan Semi's in there. Nvidia is 5.5%. Qualcomm is 5.5%. AMD is a little over 5%. Billy is 5%. And those are pretty much your top holdings, right? As you mentioned, semiconductors space, very heavily allocated to that.
Very much, actually. We believe this is the early stage of the whole 5G cycle. And, when you add the early stage, I mentioned earlier, you disrupt the legacy ones, you are building the new ones. And, semi space benefited the most, the first. And because you start building new phones, you start building the new data centers, computing powers. So that's where why we overweight semis.
Some of these names aren't obvious to me. Can you explain why Facebook and Amazon are and even PayPal and Square, why those are 5G, and Netflix for that matter?
Very good questions. Actually, people ask us that question. Well, when we think about 5G, we are not just thinking about the 5G technology itself. We are thinking about the 5G as a cycle. So in the 5G cycle, in our opinions, this is the process of digitalizing the whole economy. We always mention 4G. 4G is 4G created like a mobile internet that's connecting people, right? So that's digitalizing how people are doing with each other, how you consume information, entertaining yourself, and communicating with other people. Well, looking back, 4G is just a special case of 5G. 5G is all about connecting everything, every aspect of our economy. So that's our thesis. When you have that as your thesis, so you are really looking at the digital economy. And that amounts to disrupting the legacy technology stack, building the new ones to leverage the new technologies like 5G, like AI, like edge computing can provide you. And hopefully you're building this new infrastructure. Based on the new infrastructure, you will see tons of new applications might be benefited from that. Like a lot of people are searching for the 5G use case, killer applications. We're still too early to talk about that, but you are able to see, once as we progress in, digitalizing our economy, streaming, e-commerce, and even digital payments, they're gonna get much more benefit. So that's where what we're talking about, the beneficiaries of this 5G cycle. Hopefully that makes sense to you, Spencer.
And then last question here, Bruce. There are a lot of 5G funds out there. I own one of them. Sell us on your fund. Why would anybody want WUGI in their portfolio?
Well, we are actually dramatically different from like I5AG. Well, we talk about what we like. We talk about what we do not like. The way we look at 5G, we do not like carriers. We do not like hardware, equipment makers like Nokia, Ericsson. We do not even like smartphone makers. Why? You look at it from the value chain perspective. Take carriers, for example. They are the ones they have to spend so much money building the the 5G infrastructure and buying the spectrums. And on the other hand, they have to prove they have the pricing power. In the 4G cycle, we don't say that. 5G is such a, a disruptive technology. You have to, that's gonna enable the hyper growth. Why you don't invest in the hyper growth, companies rather than invest in the telecoms? So that's the part of we don't understand. We don't feel like they have the pricing power and the leverage to have that kind of like growth in the 5G cycle. Similarly, for the hardware makers, they get stuck, in the middle. They don't have the pricing power for the carriers. They don't have the pricing power against the chip makers. Smartphone is a tricky one, in the 4G cycle.
Yeah, no Apple is interesting.
Yeah, Apple did really well. Why? Because 4G cycle created the smartphones. That's the change from 0 to 1, right? Before that, we didn't have the smartphone. Because of the 4G LTE and the smartphone, became widely adopted because you can do so many things on the smartphone. But come into the 5G cycle, it's no longer from 0 to 1 process. It's upgrade process. Everybody just upgrade their 4G phone to a 5G phone. So the way we bet on that, instead of like betting on the phone makers, we are betting on the semiconductor companies who have to put their products into the phones, because the 5G technology is so advanced that it requires more semiconductor content, and each unit is more costly. They capture the most benefit rather than the smartphone makers. That's our thesis.
All right. Bruce Liu is the CEO and portfolio manager at Esoterica. He just spent 25 minutes with us. Bruce, appreciate the time. Thanks a lot, sir.
Thank you for having us. Appreciate it.
All right. Guys, that's going to be a wrap for the ETF show. But starting this week, the ETF show will air 3 days a week, Monday, Wednesday, Friday for a half hour. So you'll get 3 times as much ETF content from me as you were getting these past few weeks. So I want to thank my guest, Bruce Liu. Thanks to all of you in our chats. As far as future shows, I am going to have Jamie Wise on this week, either Wednesday or Friday. I don't know when. If you don't know who Jamie Wise is, maybe you know his new fund, ticker BUZZ. Maybe you've heard of Dave Portnoy, who's also involved in that fund, Barstool Sports. So that'll be either Wednesday or Friday of this week. I will let you know when that is confirmed. Until then, though, everyone smash that like button below. I don't get to eat dinner unless I get a certain amount of likes. So I want to be able to eat tonight. So hit that like button, please. And thank you. Subscribe to Benzinga. I'm going to head on over to the pre-market prep at the close show with Joel Elconin and Mitch Hotch. Hang out with you there until 4 o'clock, and I'll see you all there.